Hello, everybody. This is Jonathan. I think we are live. I think we're live. I'm trying to work this out. I'm doing a screen share with you, and I'm hearing double. Now I fixed it. Okay, so I was hearing my own voice coming through the Facebook Live, but here we are. Finally, I think we got this worked out. Now, I want to let you know today that I'm doing this through a Zoom webinar and sharing it into Facebook Live, which means we have a little bit of a lag. There's a 20-second lag between what I'm talking about and when you guys hear it. So it's going to make it a little more difficult to answer questions while I'm doing the presentation today. So why don't you just drop your questions into the Facebook chat, into the comment section while I'm going through. And then when I'm done, I'll go back through and answer questions. But anyway, today I wanted to talk about market cycles. It's a very popular topic and something I've been doing a deep dive into myself recently. So let's just go through this, see how it works. So again, today's topic is going to be about market cycles in the real estate market. This is going to be a very high level discussion. We don't really have time to go in like really, really deep, but I want to just give you an overview of the topic. Now, feel free to ask questions about the topic. And at the end, when we get to the Q&A, you can ask me questions about any topic you like, not just about market cycles. And then at the very end, I'm going to give you info on how to get that free giveaway that I promised, which is a quick and dirty deal analyzer, which I think you're going to find a lot of fun. So I'm basing this discussion on Dr. Glenn Mueller's real estate cycle. Now, Dr. Glenn Mueller is the economics professor who first identified that there is a real estate cycle. And the real estate cycle, this is going to be a real overview right here. Now, the real estate cycle has four basic phases. The four phases are starting at the lower left with number one, the recovery phase. You move into then phase two, the expansion phase. Following that, there's phase three, the hypersupply phase, and then phase four, the recession phase. Okay, now that you know all about market cycles, okay, the presentation's over. Thanks, everybody. Hope you had a good time. Now, seriously, we're going to go through each one of these individually with a little bit of explanation. So before we do that, just want to tell you where I got this from. This is from a quarterly publication called the Cycle Monitor, Real Estate Market Cycles. It's something that Dr. Mueller puts out every quarter. If you go to this website, blackcreekgroup.com/insights, you can download not the most recent one, because the most recent one, you have to pay for a subscription for it. But if you want to get it 1 quarter off with a 1 quarter lag, you can go get it. And it's quite interesting and helpful to look at. So the one that we're going to be looking at today, where this information came from, is the first quarter 2018, which just came out. So, because we're almost at the end of the second quarter. So like I said, they always put it out with a 1 quarter lag. Anyway, so now here's an overview of kind of what happens throughout the life cycle of a cycle. And as I said, we'll go through each one of these individually. So you don't really need to study this chart too much, but why don't we do that now? So phase one is called the recovery phase. And the recovery phase is characterized by occupancy being at the trough, which is the lowest point in the cycle. I just want to back up for a second and show you that, the sort of main characteristic of this, these four quadrants, is your long-term occupancy average. That's kind of what everything is based off of, right? Is this long-term, the idea that, over the course of the cycle, over the course of a very long term, there is an occupancy average that we see. Now, I don't unfortunately know off the top of my head what that average is, but there is one. Okay, so over the very long term, there is an average occupancy, and as occupancy is fluctuating around this long-term average, this is how you get the cycles. Okay, so phase one, recovery. As I said, occupancy is at its trough or its lowest point in the cycle. And the very bottom of the cycle starts at point one, is when construction from the last cycle ends. Now, this is going to make a little more sense to you when we get to the end of this presentation as to how this works. But suffice it to say that as you go through the previous cycle, you have a pipeline of construction. There's a very long lag time. Even after the cycle starts to falter, construction is still being delivered. And the very beginning of the new cycle is when the construction from the last cycle finally ends and there's no new supply being added to the market. When the bottom of the market is passed, what starts to happen is that excess supply, those excess apartments from the previous cycle, start to get absorbed, okay? That means that people, if you don't know what absorption means, it means that people start to rent them. What happens next is occupancy slowly starts to rise again. Now, you're here, you see at number one, you are down below that long-term occupancy average, right? So you're starting to rise back up toward it, but you're not getting there yet. Rents are starting to rise now because occupancy is rising, but they're still below inflation, right? They're still below the inflation rate. So you're starting to catch up, but you're still effectively losing money in real terms because your rents are not rising as fast as inflation. And finally, you pass into phase two, which is the expansion phase, when the rent increases equal the rate of inflation. So when you've hit that point where your new rents are now at the inflation rate, then that's when you pass to phase two, expansion. So what happens in the expansion phase? Well, when expansion gets going, you start having increasing demand, and that causes occupancy now to tick above the long-term average. So you're going from 6 to 7 to 8. You're basically starting to move up this chain now. Once that happens, then rents start to increase rather rapidly. Once you get to this point, you get accelerating rent growth. And you hit a point where rents start to justify new construction. So all of the developers have been sitting on the sidelines, and all of the lenders who, loan on construction have been sitting on the sidelines up until this point, where now they see rents rising to a point where they say, okay, it makes sense to start building again. But even though they start building, even though you start seeing sort of permitting happening, new projects getting underway, there's a really, really long lag time for construction. It can be a year, it can be 2 years, it can be 3 years. There's a very long lag time once construction gets started. So what happens is you've got demand continuing to build, but supply isn't coming onto the market fast enough because it takes such a long time. And that causes rents to just keep on growing even faster. Vacancy continues to fall, and you wind up basically with vacancy rising and rents rising until the construction pipeline catches up. And when you reach a point that new demand equals new supply, or new supply catches up with all that demand, that's when you hit point 11, that equilibrium point. And that's the peak of the market. Now, this point between point 6 and point 11 can actually be very, very long, because if it takes a long time for new supply to get delivered, you can have a very, very long period of time where you are seeing increasing rents and a lot of activity in the market. And that's really what we've seen over the last number of years, where we had this very, very long expansion period as the economy has slowly come out of the Great Recession, and demand has built up, and then supply started getting underway. And then you finally, it's now kind of caught up. We're finally catching up to point 11. So the next phase is hypersupply. Now, hypersupply is the point where supply growth starts to exceed demand growth. So you've had all this demand growth all this time through phase two. All this construction is now ramped up to try to catch up with it. And now you've hit the point where you're actually bringing more supply into the market faster than you're generating new demand. And what happens at this point is occupancy rates start trending down towards the long-term average. Now, they're still very high, right? This doesn't mean that they're below the long-term average. They're still above average, but they're starting to trend downward because you've got this new supply coming onto the market. And as new construction is delivered from the pipeline, your rent growth starts to slow. So it doesn't mean that rents are declining, but it means that the rate of rent growth is starting to slow down. So maybe you had 3 or 4% rent growth up until this point. Now it's slowing down to 2 or 1. Okay. And eventually what happens is experts sort of recognize this point and new development commitments stop. So you're still delivering from the pipeline that exists, but you're not starting new projects at this point. And you enter phase 4 finally when occupancy falls to number 14, which is that long-term average line. So once you have enough supply where you're back down your long-term average, that's when you enter into the 4th quadrant. Now, something really important to note about quadrant 3 or phase 3 is that most real estate experts don't recognize the peak because occupancy is at its highest point and rents are still rising at the peak. Right? And this is the point where you start hearing people talking about new paradigms. You start hearing people talk about how long this is going to last. This time is different. You start hearing these phases because things look so rosy, things look so good that people have a hard time conceptualizing that it might change. But in fact, this is all determined by the amount of supply coming on the market versus the demand. And most people miss that point in the cycle. They just miss the peak. Now, there aren't any really like long-term or devastating consequences from missing that peak because things are still pretty good for most of quadrant 3, but you are past that peak and you're now on the downtrend. Now, phase 4, what happens in phase 4? This is recession. It sounds pretty bad, but what happens now is you've got occupancy falling below that long-term average. So you're at 0.14, you're going down to 15, 16, because you still have all of that new product in the pipeline that's coming, that's continuing to be delivered, even though demand has dropped off, right? There's really nothing you can do about that because it takes such a long time to deliver these projects that they're always lagging behind. There's always a construction lag. It's a little bit off topic for us because we really talk more about investment here and buying existing product. But when, if you're a developer, getting in on that first half of the cycle is really, really good. And getting in on the second half that's when the people, wind up with those projects that fail or go into foreclosure because they mistime it or they just get in too late or, maybe they've got problems getting approvals or whatever, but it causes them to lag in construction to the point where by the time they're delivering apartments to the market can't absorb them. And that's when you really, really have trouble. Now, what happens at that point is the landlords start cutting rent because they're trying to keep occupancy up just so they can cover their fixed costs, right? So they're trying to cover their mortgage payment, their insurance, their property taxes, those things that they can't do anything about. There are only really so many ways that you can cut costs in an apartment building that you're managing. You might try cutting some staff, but then you really are going to start suffering on the maintenance things. People might start getting upset because you're not fixing stuff timely. That may cause them to move out. It'll leave a bad impression. So there's not a lot you can do to cut your costs. So you're kind of stuck if you find yourself in this point. So you're just trying to keep your head above water. On the purchase side, on the investment side, liquidity basically drops to zero in the market. And what that means, now the note here I have says liquidity is non-existent as the bid-ask spread is too great for deals to get done. Now, what that means in English is that you've got sellers who are still looking for the peak pricing and buyers who are looking at the reality saying, no way. And the gap between what people are bidding for apartments and what people are asking, what the sellers are asking, so great that you can't bridge the gap. And that gap doesn't get bridged until either one of two things happens. Either one, the sellers start getting realistic and drop their prices, or two, the fundamentals start improving and the buyers start upping their bids. But until either one of those things happen, you just have a mismatch in the market and basically transactions drop to a very, very low level. And finally, the cycle hits the bottom when new supply stops entering the market. So we're back at that number 1 point again that we started off with, where the new supply from this cycle has finally all been delivered. And now you're at a point where there's no new supply. And if you have any growth in demand at all, which you should if you have a growing population or if you have an economy that's performing reasonably well, you'll start to have more demand, more household formation, and there won't be any new supply to meet that. So the existing supply will get more demand. there'll be more people looking to rent the same apartment, so they're going to be willing to pay more to get their hands on an apartment, and this whole cycle starts all over again. So I'm sure the question that everybody's asking is, where are we now? Okay, so this is, as I said, the latest freely available report from Dr. Mueller from Black Creek Advisors. And if you look at this, this chart, you'll see that of the 54 markets that Dr. Mueller covers, there's not a single one that is not at the peak or past the peak. So if you look at, there are a number of major markets that are all peaking right now, like New York is one, Los Angeles, and you can just look yourself and see if there's a market that you're involved in or that you're near, that where it is in the world. Now, there's something really interesting about this chart in particular. When I looked at it, I noticed that some markets had actually moved backwards. Now, this is actually possible because this is all dependent upon supply and demand. This is not a one-way, progression. It has to go through in one direction. Markets can move back and forth through the cycle. And what you'll see, I've copied here the little synopsis of the apartment market that goes with the chart. What it says here is the national apartment occupancy average increased 0.1% in the first quarter, but was flat year over year. So it slightly increased occupancy. So a couple of markets moved backwards. They had been like at 12 and they moved back to 11. So he says that six markets, so there's six markets that actually improved their position on the cycle chart, and 5 of them actually returned to the peak. And what he says also is that higher interest rates and rising construction costs should help slow apartment supply in the future, allowing markets to come back into equilibrium. So that's an interesting point to recognize, that the cycles don't only go in one direction. But I have to say, just sort of looking at the way the cycles work, that you would have to have a really, really dramatic increase in demand for, say, the market to go from 11, back to an 8 or a 9. Right now, where we are in the market, we're really at the top. We've got unemployment that's at 3.8%. It's more than a point better than what's considered the natural rate of unemployment. It's difficult to imagine it getting any hotter than it is right now. So the idea that we could go dramatically backwards on this chart seems a little bit far-fetched to me. We might continue to kind of hover around the peak for a while, but when you're hovering around the peak, you never really know what's going to push you over the peak, because at that point, supply and demand, it's not just how many apartments are being delivered, but it's also how many people want apartments. And if we have a recession, or if there's any kind of shock to the system that causes people to lose their jobs, we could rapidly start going towards 12, 13, 14 in a lot of markets, with supply being stable. So just keep that in mind as you're thinking about things. I do think that caution is still warranted at this point. I mean, we saw this article I posted in the group yesterday that rents are starting to lag. So that's sort of classic quadrant 3 stuff. When you go back up here to quadrant 3, sorry, I have to go, the hypersupply, you've got, your rent is still growing at this point, but it's growing slower. And I think what we see from this headline, we've seen this, happening over the last few years, where rent growth has been slowly trending down because of the increase in supply. So at this point, I'm going to end the screen share so it's a little easier to talk to each other. But actually, that's not even true now that I think about it, is the way Zoom works. But anyway, I'm going to try to answer some questions now. So if you want to start putting them in the chat box, there'll be a little bit of a delay as I try to answer them. But I want to also just preview the giveaway that I have for everybody who's on the call. This is my quick and dirty deal analyzer. This is not meant to be a complete underwriting tool. What it's meant to do is make it easier for you to decide whether you really want to go through the entire underwriting process or not. This is an Excel spreadsheet that has gone through a number of iterations for me, but it really helps you replace that sort of back of the envelope calculation with something that's a little bit more robust. And I'm going to give this away to people who stick around, and I'll give the information about how you can get it in a few minutes. But if you want to drop questions into the Q&A, then I'll start answering them. And really on any topic, whether you want them to be about market cycles or about really anything else you have questions about in multifamily at the moment. So I see that Anurag has asked, how do general economic conditions influence these cycles? Well, yeah, I mean, they influence them in a number of ways, right? Because the demand side of the equation for the number of apartments that people want to rent that's completely dependent on the economy, right? If in a good economic period, people are going to be renting more apartments, right? More people will be moving out of their parents' house and renting apartments. More people will have jobs to rent their own apartment and move out of their roommate situation. So they'll be demanding more apartments. And conversely, if the economy starts to shrink, you'll see the opposite happen, where people will lose their jobs and they're going to have to double up with friends or double up or move back in their parents' house or what have you. And the demand for apartments will shrink. And also the way that apartments are managed, if you have a professionally managed apartment building, like basically criteria number one is like, does this person have a criminal record? And criteria number two is, do they have a job? And if they don't have a job, they're not going to be able to rent an apartment. So the economic situation definitely influences the demand side of the apartment equation. And I think it does the supply side too, but a little more indirectly, because you've got, after you've got that lag time, right, where people look at they look at the economics now, and they try to project into the future and decide whether it's worth lending money on construction projects, and they'll do it. But so the economy definitely has a direct impact on demand and kind of an indirect impact on supply. All right, I'm having a little trouble because I see some comments and some are getting lost. So I see that Darren has asked, is there an average time to move from one stage to the next? I.e., is the collapse faster than the buildup? Yeah, that's a good question. And it seems to be the case that the buildup can happen very slowly over a long period of time. As I said, like that phase two can last a long time when the economy is robust and there's a lot of demand for apartments. It takes a long time to deliver supply. So that expansion phase can last a long time. But the downside can happen rather rapidly. For instance, like if the economy suddenly stalls, the demand side could really drop pretty quickly. And you move through those last couple cycles pretty fast. So absolutely, it's a good question. So Anurag asks, are there any plays for the third and fourth quadrants, or is it strictly no buy? Well, I think certainly for the fourth quadrant, that's when you want to start looking at buying, right? I mean, you can't ever time the market perfectly, so you probably won't know when you're at absolute bottom. But I think at that point, you're pretty de-risked. And if you can find, I think what you need to do at that point is be very aggressive on bids, meaning you do your underwriting and you decide like, hey, I want to buy a 10 cap or a 12 cap, and you make bids on that basis. You're looking for sellers at that point who are in some kind of distress and need to sell. Or that's the point in the market where you may be finding actual distress deals. So deals that are foreclosed on or short sales or what have you, where there is a lot of economic distress and you can take advantage of it. So absolutely for the fourth quadrant, you'll start seeing a lot of the really smart money moving into buying apartments at that point, because they know that if they're not at the absolute bottom, they're very close and their risk is really significantly less at that point. As for the third, I'm not really sure. It's probably above my pay grade as to what would work in that situation. Since you can't really short apartments, I don't know, maybe you short REIT stocks. I don't know. Not really sure how to answer that one. Let's see. Does the student housing industry follow the same cycle? Yeah, I think that this applies to all cycles. I mean, all kinds of real estate sectors, and maybe you won't have it be as dramatic in the student housing arena, but I think you can have the same situation where if everybody piles into an asset class and you get oversupply, you wind up with the same thing happen. And I think student housing is kind of like a minor area that doesn't get covered as much. I don't see it in some of these reports, but one thing I did notice was that it had been extremely hot early in the cycle, and recently it's kind of dropped off the map. And I think what happened is there was a lot of saturation, and I think that there's maybe an upper limit on student housing in some markets because you only have so many students, and the universities don't expand as much as the population does, and there's only so many students who want to live off campus. So you're kind of capped into how much demand there's going to be. So I think that's kind of like what caps the construction in that area. So Ilona asks if there are any markets currently in the fourth quadrant. So there was, I'm going to try to go back here. So Oklahoma City, actually at the year-end report, the end of 2017, Oklahoma City was down around 15 or 16. It's actually moved back up into hypersupply out of recession. So that's the only one that seems to be there. But if you look, there's a number of markets that are getting quite close, like Atlanta and Baltimore and some others. So, but again, they can move back and forth. So Mike Crane is asking a variation of question that's been asked before, but is this a good time to be buying? I'd say it's a time to be quite cautious in buying. It's, a lot of people are in the position where they're still looking at deals because they are hoping for that needle in the haystack, and maybe they are out there, but there's a lot of bidding still going on deals. There are deals out there, and many people want to buy them. Many people who still have a very bullish view of the market, which I don't think is justified, especially just looking at this this graphic that we're looking at. But I think there's a lot of risk in the market right now. Not to say that, I'm not saying do not buy, but I'm saying be very cautious, underwrite very, very conservatively, and be aggressive on your bids. And maybe you can steal something. You can find somebody who is in a distressed situation and maybe doesn't know enough about the market to know what their property is worth, and you can get it for something for a better price. But the issue now is that if you're paying a really premium price for a property, it's just think about it. You're locking in, you're paying more dollars per dollar of revenue or per dollar of NOI, because that's what happens when you get cap rate compression, right? As cap rates get lower and lower and lower, that's essentially saying that the yield is getting lower and lower, and you're paying more dollars for each dollar of yield. Right. So when you're in that situation, that means that you're also putting on more debt per dollar of yield on your property. Right. You're basically saying, you're giving yourself less money to make your debt service. So if anything happens, you're piling on risk at that point, even if you're not leveraging the property up in terms of like going and getting, 80% from a bank and another 10% from a mezz lender, or, something like that. Even if you're not doing that, even if you're just doing, 80% or 75%, that 80% or 75% is so large in absolute terms, and it's larger compared to the dollars of revenue that are coming in, that you're making it more difficult to meet your debt service. You're making it more difficult to meet all of your fixed costs, basically. And if anything happens in the economy where demand falls off and you have a spike in vacancy, then you're putting yourself in a very risky position. Conversely, if you're buying at a different point in the market cycle, you're spending fewer dollars for the same revenue. You're buying a revenue stream cheaper. You're buying it at a discounted price, and that's building in more of a margin of safety. So if something goes wrong with the economy, then you still have a lot of margin of safety for things to go wrong before you have to start worrying about whether you're making your debt service. So that's why market cycles are important. And, just as an aside, when it's been my experience, I see a lot of people who will say things like, we buy at every point in the market cycle. Generally speaking, people who buy at every point in the market cycle tend to be very deep pocketed operators that can afford to make very, very long-term plays and can absorb losses in the short term because they have other properties that are producing income for them. So they can actually, if they get to a point where they're actually not making their debt service, they can supply that deficit from some other property that's making money, right? And their hold period is maybe forever. Maybe these are buyers that only buy and never sell. So they're looking very, very far down the road. They want to control this property because they're thinking 30 years from now, they want to own this property. And at that point, the cap rate that they buy it now is basically irrelevant, right? So people like that can buy at any point in the cycle. And also there are a lot of buyers that, if they're institutional, they're bringing in money all the time that has to be placed. Like they have to be buying. They have no choice. They can't let that money sit in cash. They owe a return on that money. So they have to buy something with it. So those kinds of players can buy at any point in the cycle and probably have to. But for folks like us who can't afford to supply the deficit for debt service in their property, that's a very, very different calculation. So you have to be very, very cautious at this point in the cycle if you're not super deep pocketed. So Raul is asking, when is a good time to start construction? First quadrant. So listen, I'm not a developer, so I don't want to overrepresent myself. A lot of this is stuff that I just pick up from watching what other people are doing. But first quadrant would be a great time to start. The problem is it's very difficult to get debt at that point because the lenders are not thinking like, oh, well, what goes down must come up, just as if what goes up must come down. They don't look at it as, what goes down must also go up. They're looking mostly from a CYA perspective, right? Now, even though they might be able to tell you, look, I've been in this business and I know right now is the time to lend. Well, what happens if they make a mistake? What happens if the economy doesn't recover and they don't get the money back? They've just lost their jobs. You can never, you're never going to lose your job by lending and expansion, like in number two, right? You say it was the perfect time in the economy. The rents justified the loan, but if you're lending down in quadrant one, where you're still, even though it makes the most sense, like, that you're going to be delivering right into quadrant two, which is when you want to be delivering, banks just don't think that way. So if you're deep pocketed and you have the money to do it, or maybe you can get private loan money from people who understand these cycles, maybe you can do it. So ideally, yeah, you would want to start a construction project in quadrant one to be able to deliver right into quadrant two. But I think it's harder to do that unless you really have like very strong relationships and very strong track record and things like that. Let's see. So Ilona says, when it comes to being cautious in current markets, are we looking at higher cap rates like 9 or 10 or higher? Yeah, I'd look as high as you possibly can because you've got to build in the margin of safety. I'm not saying you're going to be able to find those deals. Maybe very difficult to find those deals. And also you have to remember too, like cap rates are also relative to their markets, right? So one thing I see a lot of, and it disturbs me. I see like people saying stuff like Cleveland is a great place to invest because I can buy at a 10 cap or a 12 cap. What they're leaving out of that equation, ignoring all of like the fundamentals that are bad in a place like Cleveland, they're leaving out of the equation. So they're making the mistake of comparing like a market like New York, where you're buying at a 4 cap, to a market like Cleveland, where you're buying at a 12 cap and saying, hey, Cleveland is a bargain. The 12 cap in Cleveland is only a bargain if Cleveland is normally trading at an 8 cap, right? If Cleveland is normally trading at a 15 cap and you buy at a 12 cap, you're paying too much. And the idea, now I don't know enough about the Cleveland market to say this for sure, but my suspicion is that after a 10-year long expansion, where people are piling into the market. And we have things like bigger pockets, which didn't even exist at the last, the last peak, where you get even more new people and amateurs, and there's even more of a buzz around real estate investment, and you've got people pumping up Cleveland as a place to buy for newbies. After 10 years of expansion, the idea that a 12 cap in Cleveland is somehow cheap really doesn't make any sense, because money is fungible and people are looking for yields everywhere, and they're constant, and they go from one market that's got lower yields to markets that are higher, and that gap starts to get compressed. So the idea that nobody has discovered this market until now is kind of silly. So I think that even in a market like Cleveland, where you're buying at a 12, if that's true, you really need to be looking at like what the historical cap rates are in that market for this kind of product, because you may find that it's actually overpriced. Don't make the mistake. You hear this a lot in the context of single family homes, where people move from New York, where you can't, cost you $1 million to buy a 1-bedroom apartment, and they move to a smaller city. And now, they find like a 5-bedroom house for $500,000, and they think, oh my God, this is so cheap. What a bargain. And they don't realize that house really should be going for $300,000. It's kind of the same phenomenon for investors too. If they don't understand that market and don't understand the prices within that market, you can't compare it to other markets. It's apples and oranges. So just be cautious. Yeah, you're saying, so Dan's saying the realtors in OKC are telling me that Californians are grabbing properties that local investors would not touch. Yeah, see, that's an example of exactly the phenomenon that I'm talking about, where people don't understand the market and they think they're getting a good deal because they're comparing it to something that they shouldn't be comparing it to. All right. So I don't seem to be able to get any more comments right now from the view that I have, unfortunately, because I don't have the normal view since I'm using Zoom instead, so I could give you the presentation. So if anybody has some further comments, please drop them in to the chat box. I know there were a bunch that people posted early that I couldn't see because they got sort of blocked by people putting in subsequent comments. So what I'm going to do now, for all you folks who have been so kind and patient to actually watch this whole presentation, I'm going to show you now how you can get that free analyzer, which I know you guys are all excited about. So this is very, very simple. So the free analyzer, which again allows you to really simply and quickly model out a property and decide whether it's something that you want to bother going into a deeper dive with. I mean, for instance, this is going to be really, really good. For instance, we had a lot of discussion in the group about what is the proper expense ratio for a deal. And what this analyzer actually allows you to do is, if you have a price, if you've got a deal with an asking price, and you've got like bad financials and they're leaving some things out, and you're coming in with some crazy low expense ratio, this model allows you to just drop your expense ratio into the model, and it'll actually work it out for you whether that price makes sense or not, or whether you should bid something less, whether this is really just a ridiculous deal that you shouldn't even bother with, or whether it's something that you can work with and you want to analyze deeper. So I think you guys are going to find it really helpful as a way of just eliminating some of the work involved in underwriting deals. And so you can focus only on the deals that really make sense to underwrite. Now, this is where you can get it. Just email me at jonathan@multifamilywealthnetwork.com. Okay. And just put in the subject line analyzer, so I know what it is. But once again, jonathan@multifamilywealthnetwork.com. So I'm actually having a little trouble right now telling if I somehow disconnected this. If someone wants to drop a comment into the box and say you can still hear me, that'd be great. I'm not seeing the feed updating. Oh, there we go. Okay. It took a while for it to update. But so I'll answer some questions again. So Corey asks, says we bought some large multifamily in OKC in mid 2017, significantly underperforming and terrible occupancy. I'm currently in renovation on 2 of them. We'd love to hear more about that, Corey. What happened with those deals? Thanks, guys, for weighing in about hearing us. That's fine. Anurag also asks, have I bought anything of late? No, I have not bought anything of late. If anything, I'm listening with more curiosity about when people ask me if I will sell my property. But again, this lag time is a little bit irritating. I'm sorry about that. But if you guys have further questions, I'd love to answer them. And if not, you guys know where to get the analyzer from. I will be giving that to anybody who wants it. There's no limit on the number of these I'm handing out. So feel free to email me and we'll be sure to get it to you as soon as we can. All right. Well, at least what I'm seeing now is that there aren't any more questions in the group. So I will give you guys 20 more seconds from here to chime in if you've got questions. Otherwise, I will sign off and I'll see you around as I always do inside the group. All right, everyone. Thanks for your time. It was great talking to you, and I will see everybody inside the group. Take care. See you, everybody.